Hello, and welcome to another episode of the Gritty Hour. I'm here with Anthony Mannara, who has been on in the past. He's an adjunct professor, and he joined us for a previous episode when we dealt with the state of education in America. And welcome back, Anthony. It's good to have you back.
It's good to be here. Thanks for having me. I appreciate it.
It's our pleasure. Anthony is an adjunct professor who teaches macroeconomics at Fordham University. And in addition to that, he teaches um, securities and investment analysis at Hunter College, correct?
That's correct.
And today we're hopefully going to talk about the evolution of how things get traded on Wall Street, which has changed a lot in the last 23 years, I'd say. So, how's things down in Fordham and Hunter?
Things are going pretty well. Very excited about teaching. It seems to be a passion of mine that I'm sort of pivoting towards, and a lot of really bright kids that are in the schools, and they're eager and willing to learn. Some of what I'm teaching has become history, though, because as you know, things have changed a lot on Wall Street.
Yeah.
And you and I were of the generation that either trained or worked on the floors of the New York Stock Exchange, the Blue Room, the garage,
Yeah.
all of that
Well,
sort of.
when I saw you in person last, we would discuss it. I was mentioning to you on a rare occasion I would go out on the corner of Nassau and Wall and have a cigarette. And there used to be literally hundreds and hundreds of traders of different variety hanging out outside doing the same thing I was doing. They all had different colored coats for the $2 brokers and the floor exchangers and all sorts of stuff. And they've all been pushed by the wayside by automation. And I mentioned to you, and I think this will be the propellant of our conversation today. What pushed them out, for want of a better term, is the conversion of trades being settled in decimals rather than fractions, because most of those fellas and ladies lived off the fractions. So
Yeah.
if those of us old enough to remember, stocks would be quoted in like 5 and 5/8, 5.5, 5 1/4, and they lived off that fraction difference between the bid and the ask. So,
That's great.
and that's why I was thinking this would make a good podcast to have you on, as you're an expert in the field, to discuss some of these changes in the last, let's say, the year 2000 on.
Well, I think that a lot of what's happened is due to automation.
Hmm.
The ability, actually, the globalization of stocks as well, where I think European markets were already on a decimal system well before the United States was.
Right.
And it became a more perfect market, I guess, or a narrower trading market with a tighter spread. Uh, Basically due to the fact that volumes were increasing, and the electronics behind the trades started to substitute the manual labor that we all knew about when we were trading on the stock exchange.
Right.
And the evolution of what happened was it just became more and more efficient. It just started becoming more high volume, lower margin business.
Hmm.
And if I can, I'm going to share a little bit of my screen. Is that okay?
And while you're doing that, I was going to say a lot of the propellant to those changes and the narrowing of the margins, as you say, uh, was the regulatory bodies stressing the advantages to the buyer or the end user,
Yeah.
and that's appropriate, and that's what brought us to essentially where we are today.
Yeah, I agree. There was, obviously uh, the trading that took place in the old days was much less efficient, but much more lucrative for whoever was in the job. And there was a completely different camaraderie and business feel to it, as you know,
Mhm.
having worked on the floor, that came about. It sort of had gallows humor, that was what was rampant on the floor of the exchanges. That has now been substituted a lot by electronic trading platforms. There's very little or less of the ability to be responsible for trades. They are all sort of push button if you're even on the floor sometimes
Mhm.
dealing with odd lots or whatever it is that they're trading down there these days. This is basically what happened to can you see that now, Tom?
No.
Okay, hang on. Now you should. Okay. So what happened was from 1993 to about 1997, they were trading at an eighth regime. So it would be IBM trading at 100 and an eighth, offered at 100 and a quarter, and in between would be the specialist or the traders that would be executing the trades. And that spread generally allowed for much more profit to the individuals executing the trade.
Well, that's
In,
how what I guess what is called a $2 broker. That's how they made a living.
that's right.
Yeah.
And then we then went to the 16th regime in 97, and that upheld until 2001. So they were little teenies that were being traded, right? Like a
Hmm.
16th would be like IBM trading at 1 and a 16th, and then offered at 1 and an eighth instead of whatever what would happen. So the spread started to narrow. And then, of course, in January of 2001, we started getting into the decimalization of things. So everything started trading at a penny or more in difference. So the decimalization started and is still what we're currently going through at this point, which has made, we're talking about when my first job on Wall Street was when I was 17, and that was a long time ago. I guess it was about 1977, 1978, around there. And I used to call phones for brokers. And I just remember those days as being magical. I don't think they'll ever be repeated that way, but the brokers that were there had a very disciplined approach about uh, selling stock. The average volume on the stock exchange in those days was 19 million shares.
Mm.
Today we're talking about a billion, billion and a half. It's much different.
It
The
went
number of listings
in
was
the first
also,
2 minutes
yeah,
from the opening bell. Yeah.
yeah. So we're talking about something that is quite different, and it's an evolutionary process, as you know. So the volumes on the New York Stock Exchange in 2002, even up to that date, were about 80% of all volumes. So then you see the decline as the automated trading system started to take place. There's like the New York Stock Exchange, ARCA. They bought ARCA or Archipelago. It changed the name to ARCA. The British automated trading system, BATS, was there. Direct Edge is there, and the Nasdaq OMX also came into play. And as you can see, they all started trading on an up, taking market share away from the New York Stock Exchange, which eventually came to a level of around 20% of, or
That's
25%.
right before that. To underline this illustration, is the exchange was then forced to merge. It used to be a privately held entity.
Right.
Generally, it was what they called it. You had a seat on the exchange,
Yeah.
and I don't know how many seats there were, a couple of thousand, I guess. And it then merged with what was it, Archipelago? How do I say that?
Archipelago. Yeah.
Archipelago. Well, you're an Italian guy. I'll go with that.
Yeah.
Holdings, right? Back in 2006, I think. And Archipelago was an automated system at the time,
Right.
which is now called, what'd you say it was called? Arca?
ARCA. It's ARCA.
Yeah.
So
All of
that
it
was,
translates into a better price for the buyer, the individual shareholder of any particular stock. But I can, this chart you're showing now is probably the reason why they had to merge. They were forced to merge,
Yeah, well, there's just no question that they needed to buy up the ECNs, or electronic computerized networks.
right?
So there was a number of reasons. I mean, some of it was also large volumes like dark pools that started to emerge where there was block trading, right? I mean, there was block trading even in the 80s, but it started to become an electronic system. And sometimes it was even done off market, so that the volumes were never really recorded properly on the volumes of the New York Stock Exchange, but about 20 to 30% of all volumes were being matched between buyers and sellers outside of the exchanges doing block trades. So the ECNs were participants. They could buy and sell large blocks of these securities, and they could do it anonymously, right? So that was an important factor also in the overall trading. Of course, the New York Stock Exchange, here we got, I think this is the 2000, if I'm not mistaken, 16 numbers, maybe they're little old, but it's the 800-pound gorilla in all of the international markets, as you can see. And then you have the NASDAQ, and then Japan, Singapore, Shanghai, I'm sorry, Euronext here, Hong Kong, London, uh, the European countries, and then Deutsch, which is Deutsche Börse, Germany, and Korea. So
Mhm.
you can see that New York was a very significant part of world global trading, actually. Uh, then, there was also regulation that, like you were talking about, that forced a lot of this change that was coming about. And, in the early uh, 2000s, we had those corporate scandals of Enron, WorldCom, Rite Aid, all of these accounting errors that were actually uh, trades that were based on valuations that were incorrect because of lying on the part of CFOs
Right.
and CEOs. And so Sarbanes-Oxley, was put into play here. They forced changes in, actually, I don't see that here. They forced changes that to come about that would allow boards to have more uh, independent boards that would allow for more accountability on the part of CFOs that would have to sign off on their actual publication of financials. It wasn't really friendly towards European companies that were looking to trade in America. So the ADR market, for example, because of the reporting requirements, became more stringent. So the regulation it was a double-edged sword. You couldn't get a lot of the companies in Europe to abide by the standards that were required to trade in New York. So they abandoned a movement which in the early 90s was moving towards, or in the late 90s, was moving towards foreign stocks all listing on the New York Stock Exchange. And, you know, uh, it's a combination of, again, the evolution of what's happening now. Also, we can talk about the latency of some of these trades, right? There was some trading that that didn't allow uh, what evolved was not only electronic trading but speed trading and automated trading that
Day trading.
day trading.
Yeah.
And the latency is the frequency that you can execute with on an electronic system. So it depends on the hertz that you have. And they actually had companies that would move their offices closer to the exchange in order to have a shorter distance in order to get the electronic signals into hyper trading, like what they would do. Now they would do this trading for very, very little profit, but at the same time it was executed in a way that would allow them to to bring about, even a couple of pennies on a trade. But if
Right.
you're dealing with billions of dollars, this is pretty significant stuff.
Right.
So uh, the system was all encompassing, and it did allow for a number of different types of systems to come in. Uh, you know, the crash on 87, if you recall that, in part was attributed to electronic trading, right? It was uh, what did they call it exactly, Tom? Automated trading. What was it? I can't recall, but it was trading that was basically program trading. That's what they
Mhm.
called it. And they would have some kind of an algorithm that would detect whether if they were to buy and sell certain types of securities, they could arbitrage a certain amount of risk-free uh, profit out of an arbitrage trade between the two securities, for example. So all of this was taking place, uh, and as AI has developed even more sophisticated since then, there are a lot of black boxes that people have developed that help to let's say uh, they market these black boxes to mutual funds or to individuals and try to get them to invest in these automated systems that they believe will render some kind of a greater return than what it is. And I think that also accounts for the greater volumes that are on the exchange these days. Before, people used to just buy a stock, put the stock certificate in the safe, not look at it for 20 years. And then all of the volumes started to accelerate as automated trading started to become more sophisticated and proprietary trading started to come into account. The Volcker rule, for example, in 2008, started to limit the proprietary trading allowed out of banks. So all the regulation that's come into play to help legitimize, and usually it comes after a crisis, right?
Mhm.
In 2004, it was because of the Enron and Rite Aid and WorldCom scandals. And since then, Arthur Andersen was completely blown away. I mean, they just eliminated Arthur Andersen as an accounting firm because of the negligence that it had towards the intercompany sales of these companies that were being registered incorrectly.
Well,
So,
that crash you mentioned earlier from the 80s
yeah.
is what promulgated the fail-safe stop if the market swings
Oh,
back.
yeah, the collars that were put on the markets, right?
Yeah, the stopgap measures. What I forget, I don't remember the particulars. I think it was if it went down a certain percentage, it would hold for an hour.
Right,
Another percentage
exactly.
would hold for.
They put collars on the actual trading system so that if there was a significant amount of down volume, say the markets were decreasing more than 10% or whatever, uh, trading would halt for a period of time in order for the panic to cease and that they wouldn't continue. Now, did it work? Well, sort of a little bit, but it would continue on a downtrend once it would continue to run. However, it would start to slow down the downward momentum that was
That
available.
I think if it hit a certain percentage after the first two, I think
Yeah,
I think it was
20%, I
out.
think.
One was like 3 hours or something, and then it would close for the day
Yes.
if it hit a certain percentage, which it hasn't occurred yet, thankfully.
let's hope let's hope it doesn't.
Yes,
Today's today the market was down roughly 600 points based on Powell's testimony to Congress,
it's
but
funny
that's
you said
another
600
story.
points because that was considered a crash, the one in the 80s.
Yeah, but
600 points.
proportionately, I mean,
Yeah,
the market's now
percentage
at
wise, yeah.
32. Yeah, it's
But
32.
600 points down was an unheard of number back in 1986 or 87.
87, it was the biggest percentage loss. You're absolutely right. That
Mm,
was the biggest percentage loss.
yeah.
And I recall it as being a very scary moment. Yeah, a lot of people had to be let go because a lot of these firms had hired aggressively, and I was an MBA starting my career at Payne Weber at the time, and shortly after that they started letting a lot of the MBAs go. So it was a scary time.
Yeah.
And in New York in the late 80s, there were very few jobs in finance, as you might recall. I don't know. So my career eventually took me towards the tack of internationalization. I started working for Italian bank, then Citibank moved me to Rome. So in 89, 90. And so, things happen. People pull themselves up and eventually they find whatever paths they can. You got to be sort of creative, flexible, not afraid of change. And that's been the story of my life in finance. I don't know about yours.
Well, well, to one extent or another, it's everybody's life. But I do recall when I was a very young man, new on Wall Street, the operation side, or better term would be the back office of brokerage houses.
Right.
If you wanted to have an operations, and no, everybody was self-clearing back then, for the most part, um, you had to be in New York because that's where the population of people that knew what they were doing operationally
Yeah.
lived.
Yeah.
I remember the first one was the Bank of America out in San Francisco started recruiting New Yorkers to move out there. This is the back office side of the Wall Street business. To move out there because they were starting a fully operational brokerage house out there.
Yeah.
And I think that was the tip of the iceberg or the point of the spear, if you'd like. Um, and it was exacerbated in 2001, which I think I spoke to you in person about after 9/11. FINRA, which is the governing body, the main governing body of brokerage houses, uh, came out with a rule that every brokerage house, which at the time was basically centered around, still around the Wall Street area, had to have a secondary emergency location. And I remember my firm at the time had to go to some place in New Jersey that had like a bank of computers that I'm sure they rented out 58 different times to all the brokerage houses um, as an emergency backup location. This was after 9/11. So that had a profound effect on brokerage houses and where they're located.
And the costs associated with it, right?
Well, yeah, that was an additional cost. They had to lease it. Um, and again, it was just this room with a bank of computers that I'm sure at least 20 other brokerage houses leased the same computers. So I don't know how they would work that if it did come to a cataclysmic event where they had to all share these computers. But yeah, again, that's one of the things that has changed on Wall Street. I never saw so many dog walkers. I left Wall Street in 2010, and walking around, you see so many people walking dogs. You knew they weren't in offices anymore. They were
Well,
converted to apartments.
right now I'm doing. I have a firm that raises capital for companies all over the world, basically. And you were talking about automation and having to be in a certain place, and you said New York. First of all, you know how we used to call on the phone and everybody would be prospecting on the phone. Nobody answers his phone these days. Nothing. It's like, you have to send emails. You have to follow up with emails. If you can, it's fine. And nobody's in an office. They're all working from home,
Do they
at
call
least
it
from
cold
what I could
emailing? I
tell.
don't know how they call that. Cold emailing?
Well, yeah, you cold email and then, yeah, that's true. You prospect through email. Uh, you try, I mean, their phones are not accessible because most people are using their cell phones. I've recently discovered a database that allows you to get people's cell phones. So I've been calling them, and people are freaked out that I'm calling them after a follow up to my email. But I got to try and talk to these people. It's like the way we used to do it was always on the phone. People would talk to you. So now it's a much different buy side, and I just, it's amazing, and you can harness. There's a plus side to it that you can harness the whole world. So you could talk to people in Asia, in Europe, in South America, whoever has got the money, and you locate these funds that are just all over that might be specialized in a certain area that you're operating in. I'm happening to concentrate now on electric vehicles and carbon reduction
Okay.
with EV. And some funds are specialized in that area. So they're not all located in New York. Some are in California, some are in, Asia,
I would
some are,
think so. Yeah.
yeah, some are in Europe. And so the beauty of the technology today is that you don't have to travel to go meet these people and knock on their door, and you have a broader reach. That's good.
Yeah.
Bad side is you can't use your the skills of whatever you've learned in terms of being a great guy and a salesperson and trying to cajole somebody into the trade or the investment.
Your,
And so
your,
it's just much more cold,
your
analytical.
personal charm doesn't come through as
Yeah,
well.
but and those are all skills that you had to develop, right?
Right. Right. Yeah. Over the course of time, sure. Um,
So, the world has changed, and my point is that there's good and there's bad to it, but you have to continue to adapt because change in this business, change has always been happening.
right.
I was telling you that I was working at Lehman Brothers when I was dialing phones, and there was magic to this business where I would see brokers coming in, starting young. They had holes in their shirts, they looked sloppy, and I would work on the summers. So I'd come back every summer, and the same guys that were the sloppy, but I mean, I could tell they were talented. Yeah, I just remember this one year I came back and I followed this guy out the door one day, and he seemed sharper than he was the year before. He had a green Rolls Royce waiting for him. It was his Rolls.
So
So I
somebody
said,
picked up
"There's
his phone
something to
calls.
this business that I've got to learn about."
Somebody picked up his phone calls.
Yeah, and those were the days when the commissions were much higher. There was no regulation on trying to pare it down, and
Hmm.
uh, you know, brokers were making at Lehman were making 4 times the market share of any other place on Wall Street. And I happened to work for a guy that was one of the top brokers, his group at least, Marty Shafroff, who was number one on Wall Street for a long time. And just being in that carriage house of Lehman Brothers, these guys would be throwing dollar bills out the windows, just to have fun. That's, the kind of camaraderie that was there and the affluence that was there. And just amazing to see. It was really amazing to watch.
Yeah.
And of course, those types of situations slowly dwindled. Lehman became an international global broker and
Yeah.
followed the fate that it did
I was going
under.
to ask you, Anthony, when you're teaching investment analysis at Hunter,
Yeah.
what do you go deep in the weeds until like, or do you just show them broadly like how to read a financial sheet? Or,
It's a very encompassing course. I mean, it has everything, and I try to make it a course where, most kids don't know the difference between a stock and a bond, right? But the book that I use is Bodie Kane and Marcus. It's a traditional people who are on Wall Street know that book. If they're on their asset managers, they've certainly studied out of that textbook. And there is subject matter there that not only teaches you, what a stock and a bond is, how to diversify, a portfolio. You use either asset allocation to diversify, or you could also diversify by stock selection, sector selection. There's a number of different topics that are I think it gives you an in-depth look at all of the nuances of, what a mutual fund is. Why would I pay anybody a commission or upfront fee or back end load? Which funds would be most likely to give you a greater return? Those that have lower annual commissions, right? So I mean, you look at all the scenarios, then you have to learn how to read a balance sheet, income statement, cash flow statement. We look at options, so we do, puts and calls, and we go through some strategies of straddles, bear bull, bull spreads, bear spreads, and so there's a lot to it. Now, does everybody understand and absorb everything? Probably not, but they have to go through the exams. We have two midterms and a final, and generally they do pretty well. So I think it's a great course. We also do, like margin. Do you buy on margin? What are margin initial margin requirements versus you know margin requirement, the required margin requirements that are imposed by the banks or the SEC. So yeah, there's a lot.
I
There is a lot.
remember when I was taking a class when I first took the Series 7 exam, so it's quite a while ago, the teacher saying how margin was the most genius thing ever invented.
It depends on whose part you're talking to. If
Sure.
it's a broker, yeah, they make a lot of money.
Well, yeah, but even as an investor, I mean,
Yeah, you can do it, but you also there's a double-edged sword in a way, because if the market goes down, your losses get accelerated as well.
well,
So
that's
it's
why you
not
buy
just
puts. You buy puts to protect yourself.
yeah, you can do that, but that's sophisticated. That's starting to get into like the next level of what I teach. So
Yeah,
it's not,
yeah.
uh, but
I still remember that guy. He was so enthusiastic about teaching margin,
yeah,
um, how great it was, and it is. I bought on margin many times, but
yeah.
you can get burned if you're not careful. That's for sure.
Exactly. Yeah. And
Sells
you're
too
also
much.
paying that you can get burned and there could be a margin call, as you know, and you would have to pull out more money than what you had already invested, right? So you're not expecting to have reserves set aside in the event of some calamity happening.
Yeah,
Today would have been a bad day for somebody on margin, right?
yeah,
600 points down.
yeah.
So uh,
Thing back in the '80s, that very same crash you were talking about,
yeah.
was in operations, and we were there till like 1:30 in the morning sending out margin calls. So a lot of people were
Hello,
not happy.
hello, Mr. Jones, Mr. Jones.
I think they still use telegrams back then, So not to date myself, but there it is.
Yeah.
But yeah, but do you take like a particular stock as an example? Well, before I even ask you that, what is your student? What comprises your students? Are these people looking to get into the stock market as an occupation?
Some of them are looking to get into Wall Street or become analysts. Most of them start off as accounting majors. So I have a lot of accounting majors in my field. And, I'd say about 20-30% go into a career in finance. So I've got, some that have either gone to graduate school, like Baruch or some of the others that are city colleges. I tend to, I think we have a major problem on hand with the educational system in our country, as we spoke about on prior programs of yours. I don't believe that the cost of education is something that people can bear on a loan. Students are just getting indebted. If you go to a competitive business school, it could be anywhere between, you know, 60,000 to $100,000 a year for 2 years, and you just go to business school, 200,000 in debt, right? That's really tough to have to pay back.
Right.
Uh, they boast about starting salaries. I know at Columbia they're about $160,000 just to start out. But do you keep that job? I mean, a lot of people hire you, and somewhere down the road they'll decide whether we're going to keep you or not. So you might have that $160,000 salary for a year or two after you sweat bullets to get into that job. But if a downturn comes, you're going to get cut, and they're gonna lighten their salary loads. So then you have to go out and look for another job, and it's highly unlikely in a downturn that you're going to find something that's going to pay you that much.
In the same
So
industry, yeah.
I tend to prepare my kids. At least I give them a presentation, and I call in one of the managers from the CFA exam, the this Chartered Financial Analyst exam, which costs a couple of $1,000 maybe to get you through the whole program, maybe 3,000. And there's three levels of exam. It's self-study, but if you're motivated, you can get through. And that degree, and I can tell you, having worked on Wall Street, is just as respected, if not more, than an MBA from a good school. So I try to tell them, you decide what you want to do. Do you want to get it 250,000 in debt and have a really great MBA, or do you want to, spend 3 years of your life self-testing, motivating yourself, getting through the level one, level two, and level three, and coming out with a credential, which is just as good. So I try to make it because a lot of these kids, like I mentioned to you in the last program, they're first generation Americans, and they're the first ones to study in America, and they're not aware of things like the CFA exam or other programs, or even how to manage the costs of financing it.
Hmm.
It's a major issue, and
Is
you know,
that both for Hunter and Fordham University, the students?
well, Fordham, I'm teaching a bunch of. It's a core curriculum at Fordham, so I'm teaching macroeconomics, right?
Mhm.
And it's generally it's more for freshmen, sophomores, and in the Hunter program of Securities and Investment Analysis, it's more an upper level elective that they're taking. So I've got juniors and seniors, and they're well on their way as to deciding what to do with their careers. And some of them are going to graduate school, some of them will be going to, finance courses or some kind of, I mean, not finance, finance business. It could be, one of the big accounting firms like PwC or some of the others are, Ernst and Young, where they do have also departments that are not doing M&A, but they have M&A services involved with it. So it's not entirely just accounting. They're trying to broaden their scope away from just becoming accountants, and some of them are at least. And this course will help them to do that, I think. And I've been teaching it for 6 years now there, and very. I mean, generally, I've got a lot of interest. Mostly like 25 to 40 students decide to sign up for it, and it is something that I believe I wish I had when I was in college. I didn't really have a course that alerted me to the capital markets, and it sort of clicked for me after college. I was an economics major, but we were talking about money supply figures and different things, the Federal Reserve System, open market operations, but we weren't really talking about different instruments that you could have, money markets, CDs. You could have fixed income securities like government bonds, regular bonds, corporate bonds, rating agencies. What does that mean? You throw in the whole bucket, and then you got your equity markets, which you try to make sense of after many years of evolution. So
I guess another change now that you're describing that is the move for the individual investor, the move away from self monitoring their account with say 15, 16 different stocks, maybe mix in a couple of municipal bonds or whatever, to mutual funds, where they're letting uh, a mutual fund company run. They
right.
basically pick out the kind of.
That's one of the things you have to explain to them. You pay somebody to do this for you. If you've got a demanding job, you're not going to want to sweat over every stock you've got going up and down.
Right.
So you pay somebody to do that,
Yeah.
and you pay them like 1% fee. Some of them have front end loads, some of them have back end loads, and then they've got 12(1)(b) commissions, which are marketing commissions, which you also have to pay. So it's a variety of different things that you alert these people, these students to, and so that when they go into the real world and they look for a job and they're talking to somebody who might start challenging them in a conversation, well, what do you think of this? Or what do you think of that?
Hmm.
They might be well versed in it so that they will get the job, that they're looking for.
Do you
And
teach them also the risk analysis aspect based on income, age?
Yes, the profile, know your customer, right? The KYC. So you have to know the profiles of each individual and what they're like. And obviously, if you're an older guy like us, you're not going to be trading options. You're not going to be taking high flyers.
We're balance fund guys now, Anthony. But you don't put someone who's 65, 70 years old into the same stock or investment tool that you would a 28-year-old. Just
Exactly.
yeah,
Who has their whole lives ahead of them. They can make
right.
their earnings.
A little more risk, yeah.
So yeah, we talk about that. There's a whole section also on behavioral finance, which talks about the psychology behind, how you present things, like different types of methods like framing or mental accounting or uh, uh, perspective analysis on what is actually the method that's used to help you make that decision or help someone else make that decision. That's very important on a sales tactic, for example.
Hmm.
So there's a lot of that that's in the book and in the course. And we also go through the efficient markets hypothesis, right? So you talk about the random walk theory, uh, uh, and uh, Kendall's random walk theory, where his initial data was misinterpreted, and then they realized it was all due to information flow, and how that information flow hit the stock market, and how, the reaction of the specific securities. And we study, news flow and how the actual upticks happen and how many minutes after it happens. And on the downside, sometimes it takes more time for that reaction to take place.
Right.
And that's for a variety of different reasons. But yeah, all of that is, part of, it's a lot of information, but it's, even if you've heard it once or twice and you've studied it, you might recall when someone sits on the other side of a table and tries to interview you on a job. And he goes, well, what do you think of this? Why would it move that way? You say, well, the information came out on the earnings just yesterday. That's why the stock is up or down. And, they've got to be aware of that kind of stuff.
Right. Uh, I just thought of another change since I left Wall Street in 2010. I remember when I first started on Wall Street, the
Yeah.
settlement date was T plus seven, the trade date 7, and then they went to T plus 5. And as I recall, around 2000, around the change of the century, they went to T plus 3.
Yeah.
And now I think it's still T plus 1, or maybe it's T plus 10 minutes by now. Who the hell knows?
No, I think it is still T plus 1. I think. I mean, I may have lost you somewhere because I only recall T plus 2, but you're probably right. At this point, it's probably T plus 1. Trade settle right away with the
Well, it's
clearing.
T plus 1 when I left Wall Street. It was already T1. So if you traded it today, it had to settle tomorrow. So that's just, and
That's
it,
how fast money moves.
I was
These
just going
days.
to say how lightning fast it does move. Yeah.
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 I mean, I remember having to mail a check to the broker.
Well,
The
sure. Yeah. And you
check is in the mail.
I,
Yes,
I guess I'll
watch it.
just I just remembered another change, which is stock certificates. You mentioned it before. There's relatively no such thing, as I
Yeah, there
recall.
isn't anymore.
Uh,
They're
they,
all journal
they had a
entries.
what they call a DRS system, where it's directly registered into an account for you. Where it's held, I have no idea. Probably electronically somewhere. So if you bought 100 shares of IBM, you would get a little notification that you own 100 shares of IBM. So if you're get the certificate, put it under your pillow guy, you're not going to get it anymore. I remember people used to buy Playboy just to have the picture of the naked lady cartoon on the top there. And the other stock that reminds falls into that category is Boston Celtics, or a public company. I don't know if they still are, but back then you could buy a share of the Boston Celtics and get a physical stock certificate. It was a novelty, really.
Yeah, well, in Italy, I lived there for 22 years, and I married an Italian, and she always complained that I never got her an engagement ring, right?
Okay.
So I said, honey, you don't need an engagement ring. I've got I'm sorry about this. I just bought you shares of Bulgari. So they just went public. So I gave her the certificate.
You can wrap it around your
I
finger
said,
if
you
you want.
own the jewelry store.
You can put it on your finger if you like. Yeah. But that's the thing. That kind of aspect is fallen by the wayside, you know. Uh, and it's the God's honest truth. People would buy stocks because they like the look of the certificate.
Well,
Yeah,
you're owner in like you said, part owner of the Celtics. That's pretty cool.
yeah,
I heard that they're starting to do that now with art. They're getting, masters and selling pieces of a Picasso that you can own if you want it.
that's yeah. Um, and NFTs. That's the other thing. Oh, how do you feel about Bitcoin? Let me ask you,
Oh,
educated.
it's just the question. I've been trying to wrap my head around Bitcoin for years now. And, I think that there's a legitimate technology behind it. The traceability of where it is and how it emanates and the blockchain part of it, I get. But what I don't get is how that could become a currency. And the volatility that was behind it is just out, you know,
Well, there were a lot of tears recently. The people that own
yeah,
that.
the BDX, I think it was, that lost $36 billion. The
Right.
guy got thrown in jail, or he's going to trial now, and it's it's happening too fast. I think I'm not saying that it's wrong. Maybe it'll become a reserve currency someday. Who knows? But right now, I don't understand it, and I don't like investing in things I don't understand. So that's what I teach. That's what I tell my class, at least, because I had a kid talking about, oh, Bitcoin. I go, can you explain to me what Bitcoin is? And you go, no. And you own Bitcoin.
Mm. No, you hit the nail right on the head. I don't want to go so far as to call it a Ponzi scheme, but if they were trying to become a currency, I can't see them becoming a currency until they're backed by, like the U.S. dollar, the full faith
Well,
and credit.
no government has backed it. So, I
No,
mean, yeah,
that's my
if
point. Yeah.
if a government decides to give its full faith and credit, then that's fine. But I think the dollar is still the reserve currency right
Well,
now.
the first country that does do that, it then gets tied into that particular country, you know.
Yeah.
So if it's America, which is not going to happen, I don't think in my lifetime, that's one thing. But what if it's, uh, Nigeria or something, you know?
Well,
Then it becomes the value of whatever the full faith and credit you have in the government of Nigeria. See, so
yeah, I would be shorting it if that were the case.
to resolve that, I don't know how you would back it with anything credible that would make it sustainable.
Well, even the dollar went off the gold standard, right?
Mhm. Well, yeah. Hmm.
We once had it collateralized, but it is the currency utilized for a lot of global trade, like oil is traded in dollars. So,
Right.
uh, people usually have their foreign currencies go to the dollar before they go to any other currency in exchange. So it goes, Swiss franc, dollar, then euro, or
Yeah.
whatever it is. So it becomes a cross reference
It
for,
forces every country in the world to
yeah,
hold reserves of U.S. dollars,
right.
and so I don't know how you would call that. It sort of sets up its own collateral by that, you know.
Yeah.
Um, but it's interesting enough, you know.
Yeah. And a lot of our debt, as you know, is, held by foreign investors too. So,
Right.
China was one of the largest debt holders of our country. I don't know if it still is or not, but uh, you know,
Well, by virtue of that, they're also one of the largest holders of reserve dollars.
yeah, they have to be. I mean, if they've got that many assets in dollars, so
Right.
they and what's scary is the threat of a lot of these people on in Congress right now that are starting to threaten uh, a movement against increasing the debt ceiling, which would allow us for the first time default on our debt obligations, which would be calamity in the international markets.
That would not be a good economic move, no.
It wouldn't be a good move, period. You're right.
Yeah.
So I don't know.
I
Uh,
think cooler heads will prevail on that one, but I get they're using it as political leverage right now, so
yeah, they are, but it's
I,
still
I wouldn't
unsettling.
read too much into
The
it.
markets react to that kind of stuff,
Well,
though.
true. That's exactly right. You're right about that.
So,
Yeah.
if they make this theater, political theater, Wall Street starts to get jittery. It starts to sell off. There's a lot of hurt that can take place, and
Well, I think Wall Street or the financial markets in general would rather have more debt than um, a default.
right,
So
right, yeah,
it's a choice between a rock and a hard place, really.
yeah,
But I wanted to touch on one other thing, and I touched on it before, but I didn't explore it. The young investor,
yes,
the people of the age of, I'm assuming the students you teach, or maybe the ones that have just graduated from college or whatever. Are they doing an investment analysis before they invest in things?
yeah. It's interesting. I have had, I would say, maybe in 6 years, people approach me with models that they've developed. Okay, so and I would say about 5 people did that. So some of them are very quantitative, and they have run, their Excel sheets, and they talk about, they actually do spreadsheets that will calculate earnings or do a dividend discount model that they believe can bring them an intrinsic value of what the stock price should be trading at, and that is encouraging. Uh, and then you've got, the majority of the class that just, is trying to figure out what is a stock, what is a bond, and it's a different type of situation. And I told them, this course will help you to understand eventually you're going to have a 401k, or hopefully you'll have a 401k, and you're going to want to select either a fund or manage it yourself. And this course will allow you to at least target whether, the difference between a growth fund, or an emerging growth fund, or, a blue chip fund, or, a fixed
Um,
income fund, or a balance fund.
always go with
And
the balance fund.
yeah, well, it depends on the age, right?
Yeah, that's true. Yeah. Um, because the reason why I even asked that question is you can buy and sell stocks on your phone just as easily as you would send a text. It's sort of unsettling in that regard. You get your
That's
phone
the
out and open.
technology. There's no doubt technology has increased the velocity of money. The velocity of M1 is now at about, I think, 6 times almost. And that's because of M1, I'm talking about deposits, like, the things that are most liquid in cash is M1. Then you've got M2, and M2 includes things that are more like time deposits, CDs that are less liquid. Okay. But M1, the velocity is 5.5 times, which is amazing because it's been enhanced by the iPhone that you could pay with, or the Zelle account, or the Venmo, all these things that have allowed you to interact. And like you said, your Fidelity account could have an app and you could just buy and sell. I have a Yahoo, that I look at my portfolio here. I do all my trades though on a computer. So I try to take my time, but you're right. All of a sudden, people can react to some bogus news story or even a real news story and just tap a button and sell, no matter where they are,
Yeah, you
as long
could
as
sit
they
next
have
to a guy in
Wi-Fi.
the bar that says, XYZ Corp's coming out with a better mousetrap, and next thing you know, while you're having a couple of beers, you're buying 5,000 shares of it,
Yeah,
and putting your phone away. It's just kind of scary.
yeah, it is. And
There's no
that's why you're
analysis.
having a lot of volatility in certain stocks. If you've taken a look, just look at yesterday's stock price of Azul, Azul. Azul is the Brazilian airline that people from JetBlue have moved over and started there, some years ago. Stock price was up 40% yesterday, up 20% today.
Right.
It's just like, wow.
I
And what was that due to? That was because they're renegotiating their leases on their planes, and they even didn't make as much revenue as what was anticipated. But
right.
the mere fact that they had this news,
Yeah.
stock
You
was up.
mentioned at the beginning of this episode, this podcast, that you are looking at, what was it, electric vehicles?
Yeah, electric. I'm working on nautical propulsion right now. It's basically this company in Italy has taken jet technology. You know how jets compress air and have a greater thrust in jet engines. They've taken aeronautical engineering and they've applied it to uh, nautical. So they've designed jet engines that work in the water now,
Oh,
and
okay.
it gives you 40% more propulsion than regular propellers, right? And it's more efficient. It's cleaner because this technology runs on electric and it has range extenders. So you could go electric for about 20 miles, 25 miles. And then you can use a range extender, which would recharge the battery as you're going forward while you're moving, but in a more efficient way. So the overall reduction in carbon emissions is about, it could be as much as 70%. And the nautical market, when you're thinking of boats and yachts, yes, that's cool. You can get boats and yachts to do it. But when you think of cargo ships and cruise liners, then you really have, that market is just about as polluting as the airline market.
Mhm.
So even though it's a small percentage, it's about 4 or 5% of the total carbon market. You're still in a market that can be, if you can reduce that, that'll help. And also the fact that the ocean absorbs this carbon dioxide and becomes acid is part of the problem of the coral reefs and all the fish that are dying. So it's an important market. And that's what I'm working on right now, trying to fund this company.
Cool. Well, the reason I ask is because one of the things we own is a company trying to develop autonomous electric trucks,
Yeah.
driverless trucks. And they seem to be, I guess that was harder technology than they thought. I think in general, autonomous vehicles, the technology behind it and applying it to society is a little bit tougher nut to crack than the optimism that they had on it, say 6, 7 years ago. Anyway, the company I own is on the verge of oblivion, so there's always there's always
There's
one.
always one of those in the portfolio. Yes,
Yes, if you keep it as only one, then you're way ahead of the game.
exactly.
Yeah. Well,
Exactly.
I do appreciate your time tonight, Anthony. Uh, again, Anthony he teaches macroeconomics at Fordham University and securities and investment analysis at Hunter College, both in New York City.
Right.
Uh,
Very happy to be here. I really appreciate the opportunity to talk with you. I hope, this gets some listening, from the public.
yeah,
And
it was very interesting. I could see your class is probably one that I would actually pay attention to, which it's a
we
glowing.
can work something out remotely.
Did you have to teach remotely during COVID?
Yes, I did. That was a real challenge. It
Yeah.
really was, but we got through it. I'm glad we, were able to do it. That's for the next chapter.
Yeah, we'll deal with that down the road. But thank you again for coming on.
I appreciate it, and thanks for
Can I call
inviting
you
me.
professor or adjunct professor?
Call me Anthony.
All right, Anthony. Well, thank you so much. We'll see you
All
soon.
right. All
Have
right. Take care. Bye
a-
bye.
okay.